The Qs have $1 between the strikes, so that they're not really large. The strike prices are not particularly wide. And also, in most cases, you can get a penny between spreads, maybe sometimes 2 cents. For some reason, this has a 3-cent spread today. Well, we're looking at the June 5th. So I want to look at the July spreads. Here we go. July options. There's a this is a 1 to 2 cent spread here. There's a 1 to 2 cent spread here. There's a 1 to 2 1 cent spread in between these. So they're extremely liquid options. The open interest, you can see, is huge. I mean, look at these 48s here. They have 200,000 contracts open. So, if we wanted to hedge our position, if we wanted to provide, get to our position so it's delta neutral, what we would do is look at the Qs. Now, you could also look at some other indexes. I mean, you could actually beta weight your stock position here that you're buying against any of the indexes. Let's say, for example, the S&P 500 ETF or the SPY. You could do the exact same thing. I don't like to use the SPY to hedge my portfolio because they do have a little bit wider bid-ask spreads. They have 10 cents on these here. This is 5 cents over here. Make sure I'm looking at the July contracts. Yep, I am. Or you could use something like the diamonds, which is the Dow ETF. You could use that as well, but again, you've got, they're a little bit better bid-ask spreads, about 4 cents. But why use those when the Qs, not only do they have the dollar-wide strike prices, but they also have very, very tiny bid-ask spreads in those. So what I would do is I'd go back to my Analyze tab, and let's say we've analyzed our stock. We're buying 100 shares of PSYS. We've got a portfolio weighted position. Now what we want to do is we want to try to get our deltas to a neutral position to help protect our stock. Just like we did, we wanted to buy, we've got unlimited upside potential, but we also have, a limited downside potential, but the potential could go down to 0 if the stock goes down to 0, right? So we don't like that kind of position. So we're going to put in the Qs here to beta weight our portfolio. We're going to go back to our trade tab, and we're going to select a 48 put, which is just about at the money. We're going to bring that over to analyze a QQQ 48 July put, and we're going to put it into our mix and see what we come up with. Well, if we purchased one share of the Qs, or one contract of the Qs at the July 48 puts for $1.36, on a portfolio weighted basis, taking into consideration the stock that we have, it reduces our delta down to 32, or almost 33. That's not bad. Let's see if we take that out. You can see that based on the Qs, because we're beta weighting our stock position against the Qs here, we have a delta of 77. So if we purchased one put of one of the 48 puts, it gives us a negative delta of 44.96 against our 77 beta weighted position. And now we have a delta of 32. If we purchase two of these, it almost brings us to a delta neutral position, but it actually makes us a little bit short delta. What you decide to pick depends on your comfort level. Our maximum risk, if we were to purchase two of the Q48 puts, puts us into a position where if the stock doesn't move at all, we're going to lose about $267, which is acceptable in these kinds of positions. If we selected one to hedge against our 100 shares of the PSYS stock, then you know what? We have $149 of maximum risk in this position. And you know what? It does hedge us very, very nicely in any kind of downside action. In fact, if the stock drops dramatically, we can actually make some money on this stock. So our maximum risk is right around $145 if the stock does not move at all. And it also does not limit our upside potential. If the stock continues to move up, we have unlimited profits to the upside. So you don't necessarily have to buy an option on the stock that you're actually buying. Like I said, this PSYS stock looks kind of attractive with this little flag pattern going on here. Eventually, this stock will probably continue its uptrend, but the problem is, of course, is PSYS has very illiquid options. I just don't like these options because there's very few outstanding contracts here, and getting out in and out of these if we have to could be a bit of a problem, and it's going to cost us a lot more money. Using the Qs to hedge this position and give us a limited downside risk in keeping intact our unlimited upside potential is a better choice. Now let's say you've got we just selected one stock here, but we could actually probably go through a couple different ones. Even if like I said, even if the stock has option contracts on it, it doesn't mean that we have to use the option contracts on that particular stock. We only use those particular options on those particular stocks if they're highly liquid and they have nice, very, very small bid-ask spreads like it did on Starbucks. So let's go over to another, let's say another stock that we're interested in buying. Let's say we're interested in buying this Woodward Governor. It's a stock again that has a fairly low daily volume, but it looks like it has a lot of potential. I'm just using this as a hypothetical example, of course, and I'm not recommending this stock. Let's go ahead and purchase maybe another 100 shares of that. I'm just going to get rid of that just for a second. And let's say we wanted to buy something else as well. We're looking through our NASDAQ stocks in the news, and we see Fluor Systems. And that looks like kind of an interesting stock. So we're going to buy 100 shares of that. And if we go over here and take a look at our charts, FLIR, yeah, it looks like an interesting stock. It's been going up. It could be a very, very good trade. WGov, let's take a look at that real quick. Yeah, that's been going up. That looks like it has potential. So now you've got maybe three stocks here that you want to purchase 100 shares of each. And how do you protect all of these? Well, you can go back in. Let's analyze that as a duplicate trade. Let's take the Fluor stock and analyze that as a duplicate trade. Now you've got three of these, and what you've done is we want to beta weight this against the Qs here. Our downside protection doesn't look very good because we only had one contract on the Qs, but now we've got 300 shares of stock in three different stocks. How do we protect these? How do we do a covered stock position on these? Well, all we have to do is increase the number of puts that we're purchasing. Remember, when we did our Starbucks stock, if we started out with 1,000 shares, we had to buy 10 contracts on the puts in order to equal the same number of shares that we had on our stock. Because each contract, remember, is equal to 100 shares. So if we've got 300 shares of stock, then it makes sense that if we increase the number of puts that we purchased, it will give us a simulated protection, just like we did on our covered stock position. The only difference is we're using the QQQs as a hedge against our stock position. And this is the way the hedge funds, the large investment managers do it.